Greetings, members, one and all of the Salivation Nation. This is a part 2 article about supply and demand. And I think the biggest take from this is how much can the mining companies take with the low silver prices. And that's what we're going to talk about here and kind of review this blog posting and kind of take a look at some of these numbers, because I do find it's interesting to see what's going on with silver mining and with these low prices and how they could or may not rebound just based off of production or lack thereof of silver in the coming months or years. So this is by Jeff Clark from goldsilver.com, the silver supply and demand crunch. Primary silver producers are stuck in quicksand and still sinking. And as mentioned from the prior article, the silver market has entered into a structural imbalance. It is not temporary. Global supply is locked into a decline, leaving the industry ill-equipped to respond meaningfully to any spike in demand of physical metal for the foreseeable future. And I do disagree with that. I think even from the data that he showed, supply and demand are really having a conflux. They're coming together. Underpinning the erosion in supply is a deterioration in mine production, and that very well may be true. It's important because most of the bullion that I buy comes from newly mined silver. Secondary sales, products that have been previously bought and sold, will always have a place in the bullion industry and a growing role in a supply-demand crunch. But to be prepared for the kind of rush that Mike Maloney sees ahead, and this goldsilver.com is Mike Maloney's a bullion dealer company, mine production will need to be healthy and rising. It is neither of those things now, as you're about to see. Global mine production is caught in an intractable downward spiral, and the tiny sector of primary silver producers are stuck in an unhealthy quagmire. Worse, there's no real end in sight. But there's something I think we're going to find that's missing, a very important factor that's not being talked about in this article. But he says that it's both concerning and exciting. The silver miners are keeping their chin just above water's surface. Global silver supply fell last year due to a decline in both mine production and scrap supply. But the drop in mine supply was a primary contributor to the decline, and it's the primary reason why new supply will continue to fall. Most industry consultancies predict that silver mine production will be lower again this year, and as a result, drive total supply lower. If this plays out, as most analysts expect, silver supply will fall to levels last seen in 2008. And here's what the annual change in mine supply looks like since 1951. So we can see here in millions of ounces, and the supply deficits here are in the red, and you can see for 2017 it fell way below there. So very interesting. The current drop already outweighs anything we've ever seen in the past, including the 4-year drop in the early 90s. Worse, no reputable analyst I know of is predicting that silver mine output will suddenly reverse and grow anytime soon. So there's 3 reasons why this is happening, according to the author here. Prolonged weakness in the silver price, lack of new silver projects coming online, although on my channel we did discuss about some possible new places that might be one in Mexico that might be popping up. And then suspension of silver mining operations. Talked about that. The second largest mine in Mexico has suspended operations. The ongoing weakness in the silver price has kickstarted a chain reaction around the industry. The incentive for companies to spend on exploration and development has been reduced and in some cases eliminated. Ergo, there's a dearth of new silver mines scheduled to come online anytime soon. Further, a number of existing mines have been shut down because they're not profitable at current silver prices. And then there's the one of my pet topics, high grading, and something most investors aren't aware of, yet it has a direct impact on new supply. Most deposits have low and high grade ore, And what management teams usually do is mix the ore to get a more consistent grade running through the mill. When the silver price fell off a cliff, what do you suppose management teams did? Many of them began to mine just the high-grade portion of their deposits. This allowed them to remain profitable at lower silver prices, but the net result was that left behind low-grade ore that in many cases is no longer economically viable. That's because it's required the high-grade ore to be feasible, and now it's gone. Much of this ore won't be economic at higher silver prices either. And even then, miners will be reluctant to take the expense to dig it up when it's so low grade and thus less profitable. I do take issue with that because in in a prior video, we talked about one of those mines has suspended operations because of all the water that was being used. But it also it took a lot of earth to mine and a lot of energy to mine 1 ounce of silver. And apparently that was going on for quite some time, and it wasn't being stopped except for the amount of water that was used, and that was obviously not. That was due more for environmental reasons and actually just supply for the local region. Not necessarily. It seems like they could have taken this this hit with all the energy, and it's amazing they were able to do it for so long. He goes on to say it will take substantially higher silver prices for many projects that have been high grade to become economic again. And that's still, I don't see really how he gets that in. I mean, that very well could be. But again, I will say that the silver mining companies are pretty resilient. But he says that it will have an impact on the silver industry. To wit, less and less new metal is coming to market. Here's the proof. Mine capacity, the amount of new metal expected to come online each year, has fallen off a cliff. And so here is the annual additions from development projects silver mine capacity. And here you can see from 2013, 14, 15, an increase in 2016, but it's been going down since then. And the projection for 2019 is that it will be somewhat less than 2018. New silver mine production that came online last year was a paltry 4.9 million ounces, down an incredible 86% since 2013, and a stunning 43% lower than just a year earlier. You can see it's expected to fall again this year to just 3.5 million ounces. This is a staggering decline from one of the primary sources of the new metal. That's the key here. Primary sources. In other words, these are mines that produce their primary silver is produced from them. That's nothing else. If that isn't currently enough, consider this sober fact. No primary silver mine added to capacity last year. All new silver production came from gold or base metal mines producing silver as a byproduct. And that's the key. And there's still a lot of that going on. The primary silver industry has been beaten down by low silver price for 6 years now. It's had a devastating impact. The portion of silver produced from primary silver mines represented just 29.8% of the total silver mine output last year, lowest percentage of total mine supply since 2009. But that's just it. The silver has the backup being produced as a byproduct, and we'll get into that too about production cost. And he's saying that for primary silver mine production, the situation has become more troublesome. I agree with it. Production costs have hit bottom. To remain profitable and have money to spend on exploration and development of more silver deposits, a company should lower their costs, right? Yes, that's exactly what every silver and gold producer did, but you can only lower your costs so much. Most primary silver companies have now reached a point where they can't meaningfully lower costs any further. That's a problem because on average, costs are already walking a fine line with the silver price. The table shows below the current all-in sustaining costs for primary silver producers. The companies highlighted in red are producing at a loss, and the current silver versus the current silver price. The companies in yellow are on the edge, and the companies in green can produce at a profit. And how he rated these by the colors, I agree with the numbers, but the colors are another matter. This is for the primary silver producers, not that's the contingent. That's the one thing you have to keep in mind. It's not for those who are producing silver as a byproduct. The cost is much, much less than these numbers here, and that's important to consider. But let's see here. I don't know what their profit margins are, but apparently Jeff Clark does. So he's able to say that Core Mining's, it costs him $15.33 for all-in sustaining cost. But what is the all-in total cost? What's the difference between the two? All-in sustaining cost means what it is to be profitable or not. And then you have Fresnillo, which is 1052, and these other numbers here skirting towards the edge. In other words, the average is 1355. And so if you take the highest of these numbers that are skirting the edge, 1379, you can see that doesn't leave a whole lot of room between them. But a few dollars less, right around $10.50, a little bit higher, you can still remain profitable. With silver at 1478, as he types this, 3 of the 10 primary silver producers lose money. Consider that this is after 6 years of cost-cutting initiatives. It's not from a lack of trying. It's that management teams can only do so much. If you want to stay in business, you have to keep paying for labor, diesel, water, machinery, etc. But they also have, I think, some other contingencies to be able to weather these types of storms. And I'm not as familiar with that, but it's something to consider. Now, 6 years is maybe part of what is being factored here, so I'll give the author that. He says it's worse than that, though. The table is misleading because all-in, there you go, the all-in sustaining, well, the all-in cost is the 10 primary silver producers lose money. Consider that after 6 years, it's not from lack of trying. It's the cost of management for all these things, machinery, labor. And he says it's misleading because the all-in cost figure doesn't actually include everything. And that's when it excludes income taxes, working capital, financial charges, M&A and asset disposals, impairment, severance charges, etc. Add those items in, their true total cost to run a mining company is higher than the figure shown in the table, though I said some companies are highlighted in yellow. The primary silver industry does not have much ability, if any, to lower the cost in order to free up funds in exploration, development, and newer silver assets. It's potentially worse still with government to the rescue. Some in the U.S. House of Representatives want to update the U.S. mining law of 1872. They argue it was put in place 147 years ago to spur mineral exploration after the discovery of gold in California, but their update wouldn't be very fun for the mining industry. And we won't really go into that because it's not really been, it's not law yet. And I have a feeling probably if we need silver for industrial use, more than likely they may not go this route. So I don't really want to go into that. Obviously, it could be much worse if something like that does happen, but we'll see what happens here. The conclusion here is that sustainability, higher prices. Management teams will have to be convinced silver prices will stay high before they'll invest millions and millions of dollars in new projects. The problem is the silver price is too low to solve the mine supply dilemma. And then it goes on to say the silver price is like a speedboat whipping around the waves. The mining industry is like a tanker trying to execute a turnaround. The thing is I think what's interesting about this is these silver mining companies, I think the takeaway from this really is that they kind of know what's going on. They kind of see the trends of the future to a large degree. And I think they probably have hedged their bets on this. And if what he's saying is true, obviously the mining from other metals, base metals, and gold, there's enough of it to be mined that the primary silver miners out there are just not as needed. And with new exploration, I did talk about they are still looking. Obviously, their research and development, there's no need to really do it if the demand is a bit lower. And but we'll see what happens in the coming years for sure. But I don't think that we're going to see a big breakout because of this. But the all-in sustaining cost, it's interesting and fascinating to see. I still think they do average, given that the data are true, and I do believe they are. It's pretty consistent when you consider all mines put together. It's somewhere between probably $4 and $14-15 tops, for silver mining. That's a vast array, a vast range of numbers to go on. So I don't know that I would hedge or make any moves based off of this information. I think it's something to consider. We'll see what happens in the coming years, but I think the mines will react more to demand than really even price at this point. And that's where their profits will come in as a commodity, especially. And I think that's the thing to consider. They're only going to produce if there's enough demand. And as I mentioned in the prior video, which is the first part, which is based off the first part of this article here, that's kind of where things sit. And we'll see what happens with supply and demand in the coming months and year. Thanks to Chuck and Plata for sending this along to me. Very interesting indeed. Post your thoughts below. I would like to extend a multitude of gratitude, y'all, for watching, and encourage you to please rate, comment, share, and subscribe.